Hey everybody, I'm Jonathan Mifflin with the Everhome Real Estate Group, and I'm here today with Brad Hacker with Benchmark Mortgage, and we are going to be talking a little bit about what it takes to get a mortgage and maybe some questions that borrowers would have throughout the mortgage process. So, Brad, how you doing today?
Doing great, man. Nice day outside.
Yeah, absolutely.
And getting to spring, which is always a positive.
Awesome.
So,
Well, so for the people that don't know who you are, go ahead and tell us a little bit about yourself.
sure. So, as you mentioned, Brad Hacker with Benchmark Mortgage. I've been in the mortgage industry now 20 years. A few weeks ago, can't believe it. It doesn't feel like that. I guess time flies when you're having fun, or sometimes having fun or not having fun. But outside of that, just live in Winchester, a lifelong Central Kentuckian here, and typical family guy, a couple of daughters, all that good stuff.
Yeah, absolutely. Well, I've, had many clients use you. I've used you personally, and I send everybody I can to you because I think what Benchmark really does well that a lot of large banks or whoever doesn't do well
Right.
is you guys aren't the type of people that are just going to hand somebody a pre-approval and
No.
say you're approved for this much, come see me when you got a
That's right.
contract, right? That's
That's
the way a
right.
lot of banks do
Yeah,
it though.
yeah, it is.
And I think that's crazy because people really need to know what they're signing up for because you're giving them the largest debt most people will ever
Never
have
had
their
in
entire
life.
life.
That's right. Yeah, and I think that's one of the things is that I think the biggest mistake that people make when they buy a house is they think they're buying a house. And
Right.
the reality is you're making a financial decision, and so the goal should be, let's make a smart financial decision. Let's just not run out and buy a house.
Absolutely. Well, so what goes into making a smart financial decision for most people, you think?
Well, I think the biggest thing is just looking at this as a piece of your overall financial pie and not the whole pie. So looking at what are some of the fundamental things. Do I have an adequate amount of emergency funds? Because you're going to sell them this big giant thing that's got tens of thousands of parts and pieces that can all break in any minute, right? And
Yeah.
we all know that in life happens and stuff breaks.
Mm-hmm.
And so if the old Dave Ramsey line is, if you buy a house broke, it'll make you broker.
Right.
And we've seen that happen to clients over the years. So
Absolutely.
I mean, having a good solid emergency fund is a big piece of it. What does your other debt look like? Do you have a lot of bad debt? If you're in tens of thousands of credit card debt, might be a good idea to get some of that stuff cleaned up before you go buy a house. And looking at things like, is this house going to give me the ability to still have enough left over to save for my retirement long term? Because if I buy this house, but now I don't have a dollar left to save, then really, is that a great financial decision? Probably not, because
Right.
at the end of the day, it really doesn't matter what we make, it matters what we keep.
Right.
And so just thinking about things like that in the context of buying the home and making sure we're thinking about it in its place, because you and I are obviously terribly biased towards homeownership, right? We think
Right,
everybody should
right.
buy houses.
Yeah.
And I do, from the bottom of my heart, believe that home ownership is the foundation for building wealth in America.
Mm-hmm.
But there is a right way and a wrong way to do it, and we want to make sure we're helping people do it the right way, not just quoting them rates and fees.
Absolutely. Absolutely. Well, so if somebody was, in the process, just starting the process of looking at houses, they might have heard the terms of pre-approval or pre-qualification.
Yep.
And people use those terms interchangeably, but they don't
Right.
mean the same thing,
They
right?
definitely don't. The
Okay.
best way I know to describe it to you is it's the difference between told me and showed me, right? So when
Okay.
you're pre-qualified, it's based on what you've told us. When you're pre-approved, it's based on what you've showed us. So an example would be, you filled out a loan application, we've got your credit, and you told us this is how much you make. Well, that's pre-qualified,
Right.
Pre-approved is you've given me a copy of your paycheck stub, and we've reviewed it, and it matches up with what you told me, and now you're pre-approved. So that's really the biggest difference is you're pre-qualified based on your credit and what you've told us. You're pre-approved based on your credit and what you've shown us in terms of your income documentation, your asset documentation, and those types of things.
Absolutely. Well, that's important to know that distinction from a seller's point of view as well, because if
Absolutely.
if they've got a buyer that maybe has a pre-qualification
For sure.
versus a pre-approval, those are two totally different things.
Yeah,
So,
absolutely. And we actually stress to our clients, you want to move from that pre-qualified to pre-approved bucket as fast as you possibly can.
Right.
Because if I'm doing your job and I'm the listing agent, and I got an offer with a pre-qualification versus an offer with a pre-approval, I'm going to put a lot more weight on that offer with a pre-approval than I am the pre-qualification.
Absolutely. So, going from the pre-approval process, pre-qualification process to pre-approval process, part of that is pulling a credit report.
Correct.
And I know credit scores, go from very, very low to,
Right.
over 800.
Correct.
But I've also been told, or seen, not been told, I've seen that, you can get pre-approved with a 620.
Correct.
But really, what's the difference from a mortgage standpoint between a 620 and a 800 plus?
Yeah, and I think that's the biggest thing is that that's a big conception in the market. Is that mortgage lending is not one size fits all, right? There's actually up to 30 things that can impact your cost when you get a mortgage. And so the lower your credit score is, typically the more expensive it's going to be to get a mortgage. And
Right.
so, because what a credit score is really a risk score, right? So I always equate it to like car insurance. If you've had a perfect driving record and I've had 10 tickets and 3 crashes, your car insurance is cheaper than mine, right?
Right,
Okay.
yeah.
Well, the reality is if you've got an 820 credit score and I've got a 620 credit score, you're probably a much lower risk for that banker, that mortgage company, than I am at my 620 credit score. So if I'm a higher risk, then I'm going to charge you a higher cost. So credit score is one of the kind of the big things that play into what your mortgage cost ends up being. The big three are always, which we're going to get into several of these, is cash, credit, and collateral. Okay, cash. How much money do you have on hand for your down payment? Credit. What is your credit scores? And then collateral, what's the value of the house?
Okay. Awesome. Well, so another thing that I know can affect mortgage pre-approval is debt to income ratio.
Yeah.
Can you explain a little bit about what that is?
Sure. So what debt to income ratio is just very simply a calculation of the amount of monthly income that you make versus the amount of monthly debt that you pay. And typically the income is calculated on gross income. So your pre-tax income is what we start with. And then we look at the amount of monthly debt that you pay out. So the lower, that's another one of those big factors that kind of falls under the cash part of it.
Right.
Is that the lower your debt to income ratio is, the better interest rate you're going to get. Because again, it comes back to risk. So if you're a 15 or a 20% debt to income ratio, meaning you really don't have much debt at all outside of your mortgage, versus someone who's at a 40 or a 45% debt ratio, it's much more likely that you're going to pay your bills on time if you don't have all that extra debt. And that's another reason why getting out of that bad debt ahead of buying a home is a really, really good idea.
Absolutely. When you're going to put a mortgage in place on a property, I know right now interest rates are higher than they have been in some time.
Yeah.
Not historically necessarily the highest.
No, definitely not.
Yeah, but a lot of people are buying points. They're having sellers pay points, things like that. Can you explain what points are?
Yeah, so the term is actually what's called a discount point. And a point is the equivalent of 1% of your loan amount. So just to keep the numbers easy, if you're doing a $250,000 loan, that means one discount point will cost you $2,500, 1% of the $250,000.
Okay.
Now, what that is that you're literally paying that fee to discount your interest rate. And it's a very interesting time right now because the spreads on mortgages are bad because where rates have gotten a little bit higher. The reality is a lot of the loans, as interest rates start to come back down over the next 12, 24, 48 months, which is what most industry economists are predicting, is a lot of these loans that are being done right now are going to pay off, right? They're going to refinance. And so those back-end investors, the Fannie Mae's, the Freddie Mac's, the Ginnie Mae's of the world, they're not willing to pay lenders a lot of money for those loans right now because they know they're not going to be on the books very long. And so paying discount points has become much more common because if we were to rewind the clock 24 or 36 months ago, paying one discount point maybe only would get you 0.25% lower interest rate. So if rates today were at 5.25, you pay the one discount point, you get a rate at 5.
Right.
Well, right now it's about a 0.5% spread. So paying one discount point today may get you a rate of, let's just say 6.5, versus if you don't want to pay the discount point, it might be 7.375. Well, that's a big gap in rate, and that's why right now it's really a time to be working with a lender who understands how the math works, because lowest rate does not mean cheapest in today's economy, because we have to be in the mindset of how do I borrow this money as cheap as I possibly can for the time period that I'm going to need it. So even though I'm doing this 30-year loan or this 15-year loan, the reality is you're only going to need this money for another 24 to 48 months, most likely,
Sure.
because you're going to refinance it. So we need to be looking at it at a much shorter window to make sure it makes sense to whether it makes sense to pay that discount point or not pay that discount point. And in some cases it does, in some cases it doesn't. It really just depends on the individual and their plans.
Yeah, absolutely. Absolutely. That makes sense. So, speaking of interest rates, how, from a real world perspective, right?
Sure.
I mean, because we can hear about paying discount points and we hear about a
Mm-hmm.
rate, that somebody's locking in at 5.5 and somebody else gets 7.5. I mean,
Sure.
how does that interest rate actually affect your monthly payment? Because my personal experience, that's what most people care about is how
Yeah.
much each month am I going to have to pay for this
Well,
house?
and that honestly, at the end of the day, is the most important thing
Right.
because like interest rates are important and closing costs are important. But the thing
Hmm.
we always say to customers is that the thing that matters most to you when Jonathan and I are gone 6 months from now
Right.
is can I make my monthly payment? Can I make it comfortably?
Right.
Right. And so typically speaking, a good ballpark is a 0.5% in rate will generally equate to somewhere in the $80 a month range in monthly payment.
Okay.
Now, that can vary, obviously, if you're doing a very large loan
Hmm.
versus doing a very small loan.
Sure.
And so it really just depends on what size loan that you're doing as to how much that'll vary. But it's kind of in that, 70, 80, $90 a month for,
Okay.
for, for about a half a point, something like that. And that's one thing we always try to talk to our clients about is that, at the end of the day, we live in dollars, we don't live in interest rates.
Right.
And
Yeah.
that, unfortunately, the interest rate is the sexy thing that everybody likes to talk about at the water cooler. I
Yep.
got this great interest rate. But at the end of the day, what really matters is monthly payment. And a lot of times, if that 70 or 80 or $90 a month is going to make or break your home buying decision, you may not need to be buying the house you're about to buy.
Yeah. Yeah, that makes sense. $100 a month
Yeah,
doesn't,
you got kids just like I do, man.
Yeah.
I can't get out of a restaurant right now for less than
Oh,
75 bucks.
okay. Yeah.
So,
Yeah. No,
so
it's
yeah,
it's ridiculous.
it really is.
Yeah. So a lot of people also may be considering, different mortgage options as far as the amount of years that the mortgages go for. So,
Sure.
your most common, I think, right now is going to be a 30-year mortgage, but there's also
Well,
20-year mortgages and 15-year mortgages as well.
yeah,
So
absolutely.
what are the I mean, other than the years, what are the differences and the benefits to maybe not looking at a 30-year?
Yeah, so the biggest thing is just the shorter the term, the more money you're going to save over time. Now,
Okay.
again, we want to make sure that everything fits into the budget and making sure that we're doing this in the context of a financial decision because the kind of bad thing or thing we're seeing happening in the world right now is that people are spending too much focus on paying off their mortgage and not enough focus on saving money.
Yeah.
So we've got these baby boomers who are starting to retire and their asset situation looks like an underfunded 401k and a paid for house and they
Mm-hmm.
can't figure out how to live. And that's where these reverse mortgages start to come into play,
Right.
which is probably a whole other video in and
Right,
of
right.
itself.
Yeah.
But with that being said, it's all about you do tend to get a little bit better interest rate the shorter the term. So a 30-year to a 20-year, a 20-year to a 15 to a 10. And
Okay.
it varies from time to time. And you can actually, in these days, do odd year terms. So you can do a
Okay.
27 or a 23 or a 19 or whatever the case may be.
Okay.
But the most common is going to be that 30, that 15, that 20, that 10. And you're just going to pay a ton less in interest over time the shorter the term is. So
Yeah.
math would say that it's obviously better to get a 15-year mortgage than a 30-year mortgage.
Mm-hmm.
But the reality is that if I need to be owning my home and saving 15% of my income,
Mm-hmm.
well, if I've got to choose between a 15-year mortgage or saving 15% of my income, a better financial decision is take the 30-year mortgage and save 15% of your income.
Sure.
And that's what's going to build wealth over time. Now, perfect world scenario, which most of us don't live in,
Right.
would be you would be saving 15 to 20% of your income on a 15-year fixed rate mortgage in that way because at the end of the day, we all want to land at the same place. We want a big fat pile of money we can live on the rest of our life in a paid for house.
Right.
And looking at it and going, all right, for us as an individual family, what's going to be the path of least resistance or the quickest way to get there is what you should really do.
Yeah, absolutely. Well, I'm gonna throw a curveball at you that I didn't prepare you for.
Okay, cool.
So
Off script.
I saw an article and I can't remember off the top of my head where I read it, but
Sure.
there's a push from some people to get the conforming mortgages to start doing 40-year loans
Yeah.
instead of 30. Which you have an opinion on pushing it out to a 40, which in my personal opinion would probably help, the rising housing prices,
Sure.
right, to keep your payments lower. So what's
Yeah.
your opinion?
I don't hate it, and the reality is pre-housing crash years, because I'm the old guy now.
Right.
20 years in the business, is pre-housing crash years. We had 40-year mortgages,
Okay.
and we were doing some of those, and it's not a great option, because the reality is the longer the term is, the more interest you're going to pay. I
Sure.
mean, it's going to be more expensive, but I do think it's at least a viable solution for the affordability issues we have right now, because we've never really been in an environment, at least in my 20, I'm sure we have in the past, but at least in my 20 years of mortgage lending, we've never been in an environment where interest rates have risen as fast as interest rates have risen the fastest that they've risen since they started tracking interest rates in 71. So you're talking about over 50 years of data.
Yeah.
That now, have interest rates been substantially higher than they are right now? Heck yeah. I mean, the highest interest rate ever recorded was in October of 1982, when interest rates were 16%, and you had to pay 2 points to get it. But the combination of how quickly home values have risen, and that's primarily pandemic created. So when you look at, home values, depending on where you're at in the United States, here in Central Kentucky, over the course of the last 36 months, we've seen values increase anywhere between 20 and 40%, just depending
Yep.
on, like in your hometown of Georgetown. I mean, the rapid rate of appreciation has been incredible.
Right.
And probably not as high in a town like Betaville, Kentucky, or something like
Right.
that. But overall, 20 to 40% appreciation. At the same time, the cost to borrow money. So the cost of the product itself has went up rapidly. At the same time, the cost to borrow the money has risen rapidly. That generally doesn't happen at the same time.
Right.
That's an economic, anomaly. And so the affordability thing, I think it's at least a viable option. It's just one of those things, like anything else. People really need to make sure they understand what they're getting themselves into.
Yeah.
Because that 40-year term is really going to get, right now on a 30-year term, you're basically going to pay double over that 30-year term if you never pay a dollar extra. If you start stretching that out to a 40-year term, you're literally going to be paying, triple maybe
Right.
what you paid for the house in total payments by the time it's all said and done. So
Right.
you got to be careful there, but like with anything else, in the financial things like that are generally good in people who understand what they're doing, and bad in the hands of people who don't.
Sure, sure. Yeah, to me, it's like, when they've definitely started extending car loans out significantly longer.
Absolutely.
Although with a car loan, that's a depreciating asset, so that's definitely a bad
That's
idea.
a bad idea.
Right. But, with a home, you can see how it could make sense, because some of that extra interest payment that you're going to lose theoretically
Yeah.
will be made up for in equity in the property.
And I think that's a good one of those things, again, where it just comes back to, if we're thinking about this as a part of our overall financial plan, if the 40-year mortgage allows us to be able to save extra money, or to pay off other high net rate debt, or to build that emergency fund, or create college funds for our kids, or whatever,
Right.
if we're doing positive things with the money that it saves, then that's a good thing. But if we're just going out to eat one more extra time,
Right.
and driving a little nicer car,
Right.
then that's probably stupid. So
Yeah.
it really just, is in the hands of the holder as to whether or not it's a good or a bad thing.
Yeah, that makes sense. Okay. Well, so part of your mortgage payment every month, as long as you are, as long as you have sub 20% equity in the property, is private mortgage insurance. So explain a little bit about that, and maybe how somebody who has that currently could get rid of that.
Yeah, absolutely. And so you have to contact your servicer, because different servicers will have different policies and procedures for how to get rid of that.
Okay.
Something that's coming up a lot right now with the rapid appreciation. The biggest thing is if you've gotten a government loan, like an FHA loan, here in the last, I can't remember how long ago the change was, but I believe it was in the last 5 to 8 years, your mortgage insurance is forever, irregardless of how much equity you have in the house. So you're not going to be able to get rid of it. Typically, private mortgage insurance is just an insurance premium that protects the lender against you defaulting on the home. So it basically just guarantees that if you lose your job and you're like, hey, Mr. Lender, here's the keys, I'm out, that mortgage insurance is going to allow him to recoup the difference between 80% and whatever you owed on the house.
Gotcha.
So that's what mortgage insurance is, and that's why the more you put down, the cheaper the mortgage insurance is. And the other thing is the higher your credit score is, the cheaper your mortgage insurance is.
Okay.
Because again, same analogy of the car insurance that we used, right? Well, if I've got a higher credit score, the likelihood of me defaulting on that loan is much, much lower. Therefore, the mortgage insurance cost is much, much lower. And that's kind
Right.
of one of the I don't want to call it cool because mortgage insurance isn't a great thing, but it is one of the things that's been a good change over the last 48 months or so. Is the cost of mortgage insurance has came down dramatically.
Okay.
It's nowhere near as expensive as it used to be. And so a lot of times if we're thinking about some of those other boxes, say I've got a client who has the ability to put 20% down, but they're weak on emergency funds. A lot of times we'll say, like, look, let's put 15% down, because at 15% down, you've got great credit. That mortgage insurance cost is very, very small.
Okay.
You're much better off financially with $10,000 in the bank, paying a little bit of PMI every month, than you are being broke, but you're not paying $25 a month in mortgage insurance.
Right.
So again, you have to kind of evaluate it from that standpoint. And for most households, I believe the tax threshold right now is about 110, 115,000. So if you're under 110, 115,000 in just a gross income, you actually deduct the mortgage insurance on your taxes. I'm not a tax professional. Contact your CPA for direction.
Right.
But with that being said, under current tax guidelines, a lot of times that mortgage insurance is actually tax deductible.
Okay. Well, so it sounds like, again, a one-size-fits-all mortgage product is not the way to go.
No, absolutely
you need to look at your entire financial situation, and you guys help people do that, right?
For sure, absolutely.
Yeah, awesome. So, let's move past. All right, we found our house. We have got you guys. We've got a pre-approval.
Yep.
Explain. So we're putting a contract on a house, right? Explain to me what a mortgage rate lock is and when somebody should put that into place.
Yeah, so the biggest thing is that a lot of people don't understand is that mortgage rates are actually made on properties, not people.
Okay.
So until you're under contract on a house, me or nobody in the world can tell you what your interest rates are going to be. Now, there are certain lenders out there, like we actually have the program. It's called Lock and Shop, where you can pre-lock before you find that. But the problem with that is really with all lenders, is that they're going to charge you a premium for that. So if interest rates today are 6.5, let's just say, well, if you want to lock and shop, we're going to lock you at 7.
Okay.
Right. because all lenders, the reality is banks are in the business of making money.
Sure.
Let's be real here. And so they're always going to protect themselves. So yeah, and we're in an environment right now, while very unstable, it isn't uncommon for rates to change 1/4 or 0.5% day to day.
Sure.
The overall trend now is really down, and I think we're going to see slowly over time. There's obviously going to be some spikes in that, but I think over time we're going to start to see interest rates start to gradually drift lower. So Lock and Shop is one of those things was really, really hot when the pandemic started. Rates really started to climb at the beginning of 2022.
Right.
Now that's kind of died off, we've backed off of those high levels. Interest rates are about 1% lower than where they were back at the end of October at the peak.
Yep.
And so Lock and Shop, that's kind of quieted down again. You're not seeing those ads for that anymore and things like that. So once you go into contract, at that point typically is the point you would want to lock in your interest rate, because now we have that address. Now we can freeze that interest rate for you and make sure. And I'm big at locking at the time of contract, just because, as my grandmother would say, a bird in the hand is better than 2 in the bush.
Right.
And when you know we're in an environment where rates may go up 1/4 tomorrow, I'm going to take the rate that I get. And then if for some reason we do have a substantial drop in interest rates, a lot of times most lenders, including here at Benchmark, will let you renegotiate that a little bit and let you at least recoup some of that.
Okay. Awesome. So you've locked your rate. Okay. We're under contract on the property. So we've got two processes happening at the same time, right? We've got the real estate process, we've got the mortgage process, which is what I always explain to people, right? You're going to be talking to Brad's team a lot, you're going to be talking to me a lot, not necessarily about the same stuff, but we'll all meet up at the end,
that's right? Yeah, it all comes together at the end.
So one of the processes on the mortgage side is underwriting.
Correct.
And, there's no shortage of people that just, underwriters are just, their worst enemy throughout the process. So
the dark side of the mortgage lending.
Exactly. So explain how underwriters, what they do, what their function is, and just explain a little bit about that.
Yeah, so really the underwriter's job is quite honestly to protect the bank. I mean, they are making sure that this is a good loan. And in today's world, you have what's called an AUS, an automated underwriting system. And so what really happens is that, so we put all of your data into the computer and it spits out this thing and it says you're approved and it says, here's what we need to collect from you.
Okay.
Right? And so the underwriter's job is to look at that. It's called findings. That's the term for it. They're to look at those findings and go, okay, do we have all this stuff? And they're checking it to make sure that the calculations on so if you've got a boatload of overtime, making sure we're averaging that overtime over a year or 2 years, whatever the findings. So if the findings say we need to average your overtime over a year, they're going to average that over a year. If it's 2 years, we average it over 2 years. And they're just following those guidelines
Yeah.
and making sure that we're checking all the boxes. So typically they review everything against the findings, and then they issue what's called a conditional approval. So that basically just means, Jonathan, I've looked at your loan's good, it's A-okay. We need these last 1, 2, 3 things to finish up. Like a typical example of that would be homeowners insurance. We typically don't finalize the homeowners insurance until we get that conditional approval, because now we know we're going to close on time. Or a lot of times here at Benchmark, we close early. So a lot of times we're reaching out to you as the real estate agent or the client and going, hey, we know the contract date is X, but we're going to be done at Y. Do y'all want to back the closing date up a few days?
Sure.
Or do we move forward? That doesn't happen a lot right now because most transactions are a buy-sell. And so there's a lot of moving parts to that.
Yep.
But once we get that conditional approval, team goes back to that borrower, hey, here's the last 2 or 3 things we need to finish up. They send those back into them. We send that back to the underwriter. They check those off the list, and they issue what's called the clear to close, basically, which means your loan's final approved. So loans go through those stages of pre-qualification, pre-approval,
Yep.
conditional approval, and final approval or clear to close.
Okay. Is there anything that happens at the very end after you get the clear to close, right? So let's say you get the clear to close, you've got 3 or 4 days till you close on the property.
Yeah.
Is there any additional checking after that point of anything?
Yeah, absolutely. That's typically where stupid shows up in the mortgage,
Right,
in the
that's
mortgage
why I asked,
process.
yeah.
Okay, and so you always, us realtors and loan officers, we love it when stupid shows up on the scene.
Right.
And so that is hey, by the way, I just changed jobs.
Right.
Or hey, by the way, I just bought a car.
Yeah, I towed my boat into the
yeah,
parking lot.
Yeah,
You should come check it out.
You
Yeah.
should see this new glorious boat that I got. Or
Yeah.
man, we just financed a whole house full of furniture at
Right.
Haverty's,
Right.
on 90 days same as cash.
Yep.
So, it's one of those things where you definitely don't want to quit your job. You don't want to borrow money. A lot of times we say it to people, we say, whatever normal is for you, stay that way.
Right.
Until we can get your loan done. And then if you want to go nuts, I'm obviously my clients, when they're talking to me, it's funny to hear the dude who gives you big, large debt for a living tells you not to go in debt.
Right.
And I'm famous for saying that, a new house shouldn't come with a new Lowe's card.
Yep.
But with that, Johnson's got that talk from me before. And so with that being said, we're definitely hammering people not to let stupid show up on the scene and ruin our closing.
Right. Right.
But it does show up occasionally.
Of course, yeah.
Yeah.
As many times as we say it, it doesn't matter. It will happen, yeah.
That's right.
So, somebody that may be watching this and they are thinking, hey, this doesn't pertain to me because I've had a bankruptcy, my credit sucks, I got child support, alimony, whatever, like I can never afford a house.
Yeah.
What options do they have to start to get themselves in a position to buy a house?
Yeah, I think the reality is they need to start with just talking to somebody and trying to get a plan. Now,
Right.
we have to be honest with ourselves that even during the peak years, the highest homeownership ever got in the United States was like 68.4%.
Okay.
That means that even at the best of the best, there were still 32% of people in America who didn't own a home.
Sure.
And for guys like you and I who own rental property, we're a little bit thankful for that in some regards. But, I mean, just because the answer is no now, it doesn't mean it has to be no. It just has to mean that it's not right now.
Sure.
And are you willing to put into the work to be able to get yourself in a position? I think the mistake a lot of people who work with people to try to get them, they try to give them too much, and it's the old saying of how do you eat an elephant? One bite at a time.
Yeah.
Well, the reality is if you hand somebody an elephant, it kind of freaks them out.
Right.
So if I tell you the 14 things that you're going to have to do to get ready to buy a house,
Yeah.
it's going to freak you out a little bit, and you're going, screw that, dude. I don't know that I can ever get there.
Sure.
So our process looks a lot more like, hey, let me tell you 3. Let's start with 3. Go get $1,000 in your checking account, pay that credit card off, and let's look into that medical collection, maybe get that deleted. And once you've got those 3 things done, come back to us, and we'll tell you what number 4, 5, and 6 is.
Sure.
And build into it over time. And the cool thing about that is that 30% that's never going to buy, they self-identify themselves.
Right.
Because, they never call us back, and because they couldn't even do steps 1, 2, and 3.
Sure.
But the people that call us back, we're like, all right, these are people that are serious and really want to buy a home.
Absolutely.
So we give them, and we're really invested in trying to help those people get those steps because, again, there are challenges. It's as challenging now. Even thinking about the housing crash years, it's as challenging right now for somebody to buy a home in Central Kentucky as it's been really in my whole 20-year career. I mean,
Right.
it's just very expensive. Like
Mm-hmm.
even me gets sticker shocked a little bit. We did a broker open on some new construction homes this week,
Yeah.
and being in those homes, they're obviously gorgeous homes by incredible builders. But I'm walking around these homes and going, wow, this really cost this much.
Right. Yeah.
Because that's a house that 3, 4, 5 years ago you would have bought for a couple 100,000
Mm-hmm.
less than what you're buying it for right now. And
Right.
so, but if you're willing to put into work and you're willing to do the things and you're willing, it's like anything else with personal finance, right? If you're willing to do it, then building wealth is an amazing thing, but building wealth as a homeowner is like putting a supercharger on your
Yeah.
wealth building, because you got to have a roof over your head either way.
Sure.
And you're whether you own the house or whether you rent the house, you're paying a mortgage.
Yeah.
You just might be paying Jonathan's mortgage instead of your mortgage,
Right.
right?
Right.
And so with that being said, once you recognize, look, I'm going to pay a mortgage irregardless.
Mm-hmm.
I mean, they're just going to be paying mine or somebody else's. Then a lot of times that's something that clicks with people, makes them go, you know what? I do want to put in the work. I do want to take the steps, because you can't fix anything that's happened in the past. All you can do is what's with the present, and with some appropriate coaching and some discipline. Really anybody can be a homeowner if they just really want to.
Absolutely. Well, so and you guys, that's a service that you're providing. People aren't paying you to
No.
tell them what to do, to get to the proper position.
No, not at all.
As compared to maybe a credit repair company, which
Right.
is essentially going to tell them the same stuff,
Exactly.
right?
Yeah.
It's just you guys are doing it,
Yeah.
out of the goodness of your heart.
Yeah.
Hopefully they'll get a mortgage with you on the back
Yeah,
end,
exactly.
but you're
For
helping
sure.
people, and you're helping people in the community that
Yeah.
need it. So
Well,
that's
absolutely, and you're the same way, Jonathan. I mean,
Right.
the reality is that you just always try to do right by people, and good things will happen. It's going to come back to you in the end. It may not be that individual, but it'll come back from somewhere else. And if you just, it's the old Zig Ziglar quote, right? If you help enough people get what they want, you'll get everything that you ever want.
Right.
And that if you just stay focused on helping people get what they want, everything that you want takes care of itself.
Absolutely, absolutely. Well, so to finish up here, if you had 2, 3, 4, 5, however many you want to do,
Sure.
tips that somebody that is looking to purchase a home, maybe it's their first home, maybe it's their second, maybe they want to, whatever the situation is, what are some tips that they can do from a personal financial standpoint,
Yeah.
from a mortgage standpoint, that will help them be better prepared to come and talk to you and to get ready for this?
Yeah, I think number one from a personal financial standpoint is just simply get some money in the bank. I think people because even when we're looking at products that are no down payment products, whether that's a rural housing loan or a VA loan or maybe something with down payment assistance or a grant or something like that, the reality is no money down doesn't mean no money out of pocket.
Right.
So they're going to need to write that earnest money check,
Right.
right? And typically, what's a typical earnest money check in Central Kentucky? Would you say?
1% of the purchase price.
Okay, cool.
Yeah.
So if I'm buying a $250,000 house, I'm going to need $2,500 just
Right.
to stroke that check to say, Mr. Seller, I'm so serious about buying this house.
Right.
I'm going to put up $2,500 for you to hold it for me until I can get my loan done.
Sure.
Right.
Yep.
So they're going to need that. They're going to need money for a home inspection. I mean, we typically recommend that you get a home inspection.
Yep.
And that, okay, what's a good home inspection? Now I'm interviewing you. What's costing a good home inspection these days?
It depends on, because home inspections come with so many different
Yeah.
parts, right? If you went full out and you got the full home inspection, you got a radon inspection, which
Yeah.
I always recommend for people, and you get a termite inspection, depending on the size of the house too, but roughly $500 to $600 after it's
Okay.
all said and done.
Cool. So now we're 1% of your purchase price. You're 5 or 6, and then you're going to have to pay for your appraisal out of pocket,
Right.
which tells us what the value of the property is, and that could be anywhere between $425 and $625.
Okay.
So the reality is you're going to need $2,000, $3,000, $4,000
Sure.
just to get the house bought.
Yep.
Right. And then we want to have a little bit of money in reserve because number one, you and I have experienced this so much. There's no such thing as a perfect house, and
Right.
people want to make the house their house. So they're going to want to clean the carpets and paint the walls and switch out a light fixture, or change the countertops, or whatever the case may be.
Sure.
So that's where that a new house shouldn't come with a new Lowe's card comes into play,
Right,
right?
right.
And so you should have for that house, whatever money you want to put into that house, you should have the cash available to do that. And then in addition to that, you should really have about a month's worth of your monthly expenses
Yeah.
the day after you close. So that way, you've got reserves to where because even though there's no such thing as a perfect house, and the reality is the air conditioner can be working perfectly when the home inspector goes in, but we've had a client that 10 days after closing, the HVAC blew up.
Yeah.
And $5,000 later, they were putting a new HVAC in the house.
Right.
That happens. That's just the deal of, or with the homeowner that we had one that closed to where that the big windstorm that just came through had part of their shingles blown off.
Yep.
Well, they had a $1,500 deductible on their homeowner's insurance
Right.
to get their roof fixed.
Yeah.
And so it does. It goes back to if you buy that house broke, it has the potential to make you broker. So you want to make sure you got some money reserved. So I think that number one, I think that's the big thing is get some money in the bank, start saving some money for your home. I think now that doesn't mean, and to be clear about it, I mean, we'll leave you with 50 cents in your checking account if that's what you want. This is just advice, right?
Right.
But we just don't recommend that. Now, the second thing is I think you should start to get out of this, clean up some of that bad debt, whether it's the credit card debt. Credit card debt's like a big thing right now. The average balance right now is at an all-time high, over $900 billion in credit card debt in the United States.
Yeah.
According to a recent report, at an average interest rate of about 19.19%. And so the debt phenomenon in the world right now is gone crazy. So getting some of that bad debt paid down so your debt to income is a little bit more flexible because we work hard for a living, and we don't want to be house poor.
Sure.
To where all we get to do, you better, I've actually said to a client before, you better love this house because all you're going to do is sit in it.
Right.
Because you ain't going to have a dime to go do anything else.
Right.
You know. But at the end of the day, that's not our decision to make. That's their decision, their life, their money. But getting some of that bad debt paid off is another good thing. And then just making sure there's going to be enough room in there to build that. Because unfortunately for guys like you and I, the days of pensions and things like that, and, geez, who knows if Social Security will still be a thing by the time you and I retire.
Right.
We need to be prepared to be able to live on what we save. It's almost like we're squirrels all of a sudden. We got to stash it away for our retirement winter. And so making sure you got enough bandwidth in your budget to be able to still invest and build wealth and do those things on the side. So for just personal financially, those would be the three main things that I would say from a house perspective is just get pre-approved first. I mean, it's all tempting because, I'm just like everybody else. I didn't want a mortgage.
Right.
But I couldn't stroke a check for my house.
Sure.
So I had to get one.
Yeah.
And so the tendency is to get really excited about the big pretty thing, that we love to think about, but we don't really want to think about how much it's going to cost us for month. So it kind of works a little backwards, but the reality is really you should get pre-approved before you go look at a house.
Yeah.
And so taking that process to just see where you're at financially, that would be the big thing. The second thing I would say is hire an experienced real estate agent. That is a major. Hiring somebody that's a professional like Jonathan, lots of other great professionals in our market that are peers of ours, and so having a great real estate agent, particularly as a buyer. I mean, it really the way commissions are set up right now really doesn't cost you much of anything to hire a real estate agent as a buyer.
Right.
Making sure you have a good real estate agent that's got experience and can explain to you in a way and it's going to educate you on the process from the home buying side of things, who's willing to take the time to sit down and do that buyer consultation with you and talk you through the process. That's a huge, how well your transaction will go is a lot dependent on who your real estate agent is, because your real estate agent almost acts like the ringmaster of a circus.
Right.
They're the one kind of orchestrating everything, or the conductor in an orchestra orchestrating everything to make sure it all goes smoothly for you. So second thing is just making sure you've got a professional real estate agent. And then even if you're selling a house, hiring a real estate agent, because yes, they make commission and all that stuff, but the reality is every statistic in the world will tell you if you hire a great real estate agent, you're going to get more out of your house. And there's a lot of legalities to that. You need that licensed consultant to do that. They're well worth the money. And then probably the third thing, once you get pre-approved, you got a great real estate agent, is making sure that you know what your budget is. Because, the reality about houses is we see them and we fall in love.
Right.
And we all know when we fall in love, we do dumb stuff.
Right.
Right?
Right.
And so we need to make sure when we fall in love that we're falling in love with something that's within our budget.
Yeah.
And not something that we really can't afford, because then we get a broken heart, and that can obviously frustrate you.
Absolutely. Okay, Brad. Well, one last thing.
Okay.
I don't see your crystal ball here.
I don't.
But I think personally from the real estate side of it, right?
Sure.
I think that our current biggest challenge is inventory, which I'm sure you would agree with
I
that.
do agree with that.
So we just don't have enough houses on the market to sell to people. We've
Correct.
got a huge pent-up demand for
Yeah.
houses, especially with the millennial generation, which is my generation.
Mm-hmm.
I think the average age to purchase somebody's first house went up to 36
Yep. This
last
past year,
year.
yeah, 36 first time homebuyer.
Yeah, so I think that that kind of speaks to people are having to wait because there's just nothing on the market.
Right.
I don't really know a solution to that other than new construction,
Mm-hmm.
right? Building more houses is
Yep.
going to allow people to buy more houses, but that's not an immediate solution.
No.
We've got probably another decade of millennials reaching the age of 36,
Yeah.
and that's if it doesn't raise even further to 38 or something, right?
Yeah.
So, for the next 10 years, we might have an inventory issue.
I agree.
So, that's my crystal ball prediction for what the housing market looks like, or the inventory crisis looks like.
Yeah.
What's yours for interest rates, mortgage, that sort of stuff?
Yeah, I think a few things. I think number one, rates are going to get lower in time. Most of this right now, where we're at right now, has been driven by inflation. I mean, we're all experiencing that. We're all living that. Higher food, higher car prices, higher everything. I mean, There's really not much of anything that doesn't cost more than it did prior to the pandemic. So I think the Fed's fight of raising their interest rates, which by the way doesn't have a direct impact on interest rates, certainly impacts them longer over time. I think we're finally starting to reach that tipping point of the things that the Fed's been doing over the course of the last 12 to 24 months. It's really starting to work its way into the economy. I think we will see inflation start to come down over the course of the next 12, 24, 36 months, which will lead to lower interest rates.
Okay.
I think the bottom is probably where we were interest rate wise prior to the pandemic. And that was high fours, high fives. Another big thing that nobody really is talking about out there is that the federal government's been in the mortgage business since the housing crash. And how they've been in the mortgage businesses is they've been buying mortgage-backed securities and holding mortgage-backed securities. And that's the investment arm that drives interest rates. And so the federal government is pretty committed to getting out of the mortgage business over the course of the next 3 to 5 years. So as those bonds mature, they're allowing those bonds to run off rather than buying more bonds. So that's one of those things that's going to create a floor for how low interest rates get. So while I do think rates are going to be lower, I think 5 is kind of the new floor of where interest rates are. We're going to get closer to where we were naturally pre-housing crash years.
Yeah.
And that was 6 to 8%. I mean, you strip out everything post 2008 to now, and you strip out those super inflation years of the late 70s and early 80s. Normal interest rates in America, since they started tracking them in 71, is 6 to 8% almost always. My first loan I did when I got in the mortgage business, we refinanced a couple from 9.25 down to 7 on a 20-year term, and she was so happy I thought she was going to kiss me in the mouth, because she was like, "Oh my gosh, 7% on an interest rate."
Yeah.
And so I think that's probably the floor of where we get is somewhere in that 5. Now we may see some 4.75s, that may be 5.25 or 5.5, but I think that's really where rates return to. How quickly they get there will really be dependent on do we go into a recession? How deep is that recession? What does that do to inflation? Big thing to watch over the course of the next couple of years is obviously going to be the jobs.
Right.
If there's any two things in the economy that's married more than anything, it's jobs and real estate.
Okay.
Because if people are worried they're going to lose their job, they're not going to buy a house.
Right.
And they're not going to sell a house. And so we really have to watch employment.
Yep.
To make sure that it stays stable, but outside of those few things, I think, and we'll get used to what will become normal again. We just went through a period of time where I believe, certainly not in my career, if I do this another 15, 20 years, I don't think we'll ever see a 30-year fixed rate mortgage that starts with a 2 again.
Yeah.
And probably not in my lifetime.
Right. Yeah, that makes sense. Okay. Well, if you guys need any mortgage advice at all, this is the guy to talk to. It's the Hacker team at Benchmark Mortgage. He's out of Lexington, but he services anywhere in Kentucky, and he also does loans in the Panhandle of Florida now too. So
Florida, Indiana, Ohio, Tennessee. So we're spreading out.
I tried to get him to just hire me as his mortgage lender in Florida. I would have just left being a real estate agent altogether, but he said no, so that's okay. Well, I appreciate your time, man. Thank you so much. And,
always glad to do it.
Yeah, I've learned a lot, and I hope other people have as well. Thank you, buddy.
Thank you, man.